I'm here with Christian Baylis, Chief Investment Officer at Fortlake Asset Management. Christian, welcome to the Inside Network's Income and Defensive Symposium.
Thank you.
Now, much of the traditional portfolio construction theory talks of diversifying across asset classes. Is this enough to provide reliable correlations between investments?
Well, I guess the ultimate answer is that it could be. But really, I think what we're trying to achieve is we're trying to use a traditional asset class in a non-traditional way, and ultimately trying to use the fixed income market and its redeeming features as a conduit to deliver a financial outcome for the investor. Because when you think about it, diversification in all of these asset classes are ultimately there to derive a different type of return, and that's what the investor is ultimately seeking. But if we just stretch our mind a little bit and say, well, what if we can use a very liquid, deep asset class in order to get the same outcome, but in a very trusted incubation environment such as the fixed income credit market, that could actually be a good way of generating a low ex-ante risk-adjusted return.
And you've worked on an approach that uses common assets to create uncommon outcomes, you might say. Could you explain what that means?
Yeah, so really what we're looking to do is use I call it the redeeming features of the fixed income market and all of the cross currents that it has in a way to ultimately derive a return that is not correlated to credit markets, that is not correlated to bond markets, that is not correlated to curvature, inflation, all of these types of things. So we're wanting to occupy a very unique correlation sleeve within someone's asset mix, something that performs in a totally different way to all of the other assets that they have in their portfolio, but with the caveat that we do use the fixed income market and some of the redeeming features within that market.
Now, some asset consultants think about your portfolio as being a defensive alternative.
Look, in the sense that it's not correlated to risk assets, in that we run our own type of correlation and a pretty unique correlation at that relative to pretty much anything that we've seen since inception. So in the sense that when equities are up, we tend to struggle, and when equities are down and there's dislocated periods and high levels of volatility, we tend to do better. That obviously just as it happens, tends to be considered defensive. But there's no doubt that we can have good times and bad times. I guess what I would say is that our bad times tend to be when everyone else is having good times, and that's typically the way that we tend to operate. And a really good example of that was December and November of 2023 when equity markets were up 10%. That was our toughest period since inception. So that's, we can be relied upon to be run of the mill when equity markets and everything else and high yield credit and these sorts of things are doing well. But we really want to be outperforming when those things start to peel off and start to cause you problems.
And if we look in the crystal ball for a moment, what do you think might be a market surprise as we move into the back half of 2024?
I would definitely point to defaults being the market surprise. It's not priced. There seems little anticipation of such an event occurring. But really, the bungee cord has been pulled back to max stretch. I would say is that we've got clearly grassroots defaults picking up to unseen levels. I.e., 2024 is higher than 2020. We've never seen defaults and bankruptcies, Chapter 11s at this scale with this velocity, and yet on the other hand, we see no capital market defaults. That does not reconcile with our way of thinking. That just does not reconcile in any way, shape or form. We have never seen that in history. And you've got to ask yourself the question, how long can that last? How long can we ultimately defy gravity? What is the magical face cream that the capital markets are using when the SMEs are using a different type of face cream? In my experience, these things tend to be pretty fleeting, and we will come back to reality at some point. And avoidance is not a strategy. You want to lean into that, and you want to turn it into an alpha source. You want to turn it into a return source when it does happen, and that's ultimately what we're trying to do, get investors to the doorstep of that opportunity.
Quite the anomaly. Christian Baylis, thanks for joining us.
Thanks very much.